what you are seeing is the same data, the same decisions. The difference isn't in the market, it's in what you're trained to see, the noise or the structure beneath it. For centuries, we have tried to map the markets to find a reliable pattern in the chaos of prices. We drew lines between highs and lows, identified trends and reversals, and built complex mathematical models. This is what most people think of as reading market structure. It is the technical map. An uptrend is a series of higher lows. We draw a line connecting them. A downtrend is a series of lower highs. Support is a price level where buying interest repeatedly emerges, creating a floor. Resistance is a ceiling where selling pressure consistently appears. This map is logical. It's mechanical. It assumes that if you follow these rules, you can navigate. It assumes the people creating these lines are rational processors of information. This was the dominant theory for decades. But this creates a central puzzle. If the map is so rational and the people using it are so rational, why does the financial world experience such profound recurring episodes of collective irrationality? Manias that defy gravity, panics that erase logic. The map is accurate, but it is a surface-level description. It marks the where and the what. The professional needs to understand the why. To do that, you must learn to read the second, invisible structure layered beneath the price, the structure of human psychology. And for a long time, economics told us this should be enough. It assumed the people behind the prices, the traders, the investors, were perfectly rational beings. They would use all available information with cold, algorithmic efficiency. But this creates a puzzle. If the map is so clear and the people are so rational, why do markets so often spiral into manias and panics? Why do bubbles inflate, and why do they burst with devastating, predictable irregularity? The map is not wrong, but it is incomplete because it describes the territory of prices while ignoring the territory of the mind. So we have a puzzle, a rational map applied to an often irrational world. What if the key to the map isn't in the lines themselves, but in the minds that draw them? What if every line on your chart is actually a fossilized record of a shared human emotion? The field that cracked this contradiction is behavioral economics. It challenged the dominant view by asking a simple question. What if people aren't perfectly rational, but human? This shift changed how we see every decision, including the ones that move markets. Think about a fundamental market concept, support, a price level where buying has historically emerged. The traditional map sees this as a technical level. The behavioral view asks, why does buying emerge there? Often, it's loss aversion. The pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. A previous low becomes a mental anchor. The structure on the chart is a fossil of a shared psychological event. Or consider a trend. A herding impulse is hardwired into us. In times of uncertainty, we look to what others are doing. The economist John Maynard Keynes understood this a century ago. He compared financial speculation to a beauty contest, where the goal isn't to pick who you find most beautiful, but to guess who others think is most beautiful. This is where professionals separate sentiment from structure. They know that a breakout isn't just a line being crossed. It is a collective psychological shift. It's the moment a critical mass of participants abandons one narrative for another. The volume spike that confirms it, that's the sound of conviction changing. Pause for a moment. Look at any decision you've made recently, financial or otherwise. Can you spot your own hidden anchor, a story you were telling yourself because it was comfortable? Just notice it. Reading this psychological structure means recognizing that markets are not just a gathering of individuals, but a system of strategic interaction. This is the realm of game theory. In a market with only a few major players, every decision depends on what it thinks the others will do. A price war is a brutal example. One cuts prices to gain share. Competitors must choose, match the cut and erode everyone's profits, or hold and lose market share. The rational, self-interested move for each individual player often leads to the worst collective outcome. In markets, we see this as a race to the bottom during a panic. Everyone sells because they think everyone else will sell. This leads to the core ethical and existential tension in reading markets. The more you understand these psychological and game-theoretic drivers, the more you see the market not as a machine to be mastered, but as a mirror reflecting back our shared biases, our herd mentality, our fear of loss, and our capacity for self-delusion. The question shifts from "how can I beat the market?" to a more unsettling one. In this system of amplified human psychology, can anyone truly be in control? Or are we all, to some degree, participating in a collective story? You might now feel that the market is an impossibly complex web of psychology, but this is where the professional skill becomes most refined. They don't get lost in the noise. They use the map of price structure to locate where these psychological battles are most likely to play out. The key is to see the two structures not as separate, but as one single, intertwined reality. The professional's edge is synthesis. They see a higher high on the chart and immediately ask, what narrative is fueling this? Is it genuine value discovery, or is it the euphoric phase of a beauty contest? They see a tight consolidation and don't just see indecision. They see a silent, psychological accumulation. The eventual breakout is the resolution of that mass psychological tension. The early warning signs are always psychological before they are technical. Declining volume in an uptrend doesn't just mean less activity, it means fading conviction, waning interest. The buyer's story is losing its power. The professional is reading the ebb and flow of collective belief. This is the perspective shift. The market is not a foreign entity to be decoded. It is the emergent property of human decision-making under conditions of uncertainty, greed, and fear. Reading market structure, therefore, is ultimately an exercise in understanding people, in understanding yourself. The lines on the chart are the aftermath. The decisions are the event. The professional spends less time predicting where the line will go next and more time listening to what the current position of the line tells them about the state of human psychology in that moment. They are not forecasting prices. They are taking the emotional temperature of the crowd and calmly gauging their own. In the end, the most important structure you will ever learn to read is the one that governs your own choices, your own loss aversion, your own need to follow the herd, your own tendency to see confirming evidence. When you can observe those patterns in yourself with the same clarity you observe a trend line, you begin to see the market for what it is, not a battlefield, but a reflection. And with that clarity comes a different kind of question, one that extends far beyond any chart. If the market is a grand, continuous experiment in human judgment, then what does your next decision in any part of your life contribute to its shape? Share your thoughts below, like and subscribe to this channel. Thank you for watching. See you in the next video.